Quincy Krosby is the chief strategist at LPL Financials with me from Virginia. I think you'd agree, Quincy, that we are moving, forget yesterday's dead cat bounce or whatever you want to call it. We're moving into a new sphere, an air of reality that the higher interest rates are going to slow the economy and hit companies' profits.
Yeah, no, absolutely. I think it's the market coming to that realization that the Fed may not be able to engineer a softish landing, and that the higher rates, and we saw above 3% today, are going to move higher. And the Fed is going to get what it wants. It's going to slow down the economy. But the point is, at what cost? And the market is finding that equilibrium at this point. That's what it's doing. It's recalibrating. It's finding the multiple that equates to a higher interest rate environment and probably slower earnings. Not necessarily a recession, but just the recalibration. It's never fun. It's never nice to see that. But the thing is that at the end of this, investors start coming in, perhaps even before it ends, because so much is going on sale. You know, at the end of the day, the housing market isn't collapsing completely. We still need cloud. We still need cybersecurity. Semiconductors are still important. We go out to eat. We go traveling. But the issue is at what multiple? And that's what the market is searching for right now.
How far? I know, this is the how long is a piece of string question. How far are we into that process? Because I thought that the market had priced in over the last 6 months as the Fed had talked about raising rates and we'd seen the dot plot. I'd sort of assumed we'd priced in these raises, not to see this sort of reaction today.
Now, you're quite right. It's exactly the case. However, I think that when Chairman Powell made the comment, no, we're not going to have 75 basis points. For the time being, we're going to have 50 basis points. If we need 75 basis points, we're not hesitating. We'll do it. I think the market is worried that perhaps the Fed actually is not being aggressive enough at this point. And because of that perhaps they're going to have to be more aggressive down the road. You always want them to front load it. He's got a healthy labor market at this point. Why not front load it and really try to rein in inflation, particularly if the Fed believes that we're getting closer and closer to peak inflation? So I think the market is basically saying, we don't think right now that your plausible softish landing is actually going to happen without more aggressive, believe that or not, more aggressive action on the part of the FOMC,
Bill
the
Dudley,
Fed, actually.
Bill Dudley, former head of the Fed, New York Fed, said, of course, that, you know, asset prices have to fall. Well, we're seeing that, and I suspect one will eventually see it in the housing market. But he also said unemployment has to rise. And there are tight labour markets at the moment on both sides of the Atlantic. Do we need to see, as part of a reduction in wage demands, also an increase in unemployment, do you think?
Well, that's the question, because the fact of the matter is when wages keep rising at the rate that they're rising, and if in the U.S. we don't have more folks coming into the labor market to provide supply, thus not having to give, signing bonuses and higher wages. The worry is that you start to see the effects of a wage price spiral. We're nowhere near where it was in the late 70s, but you're starting to see that. And there's one thing, once you give higher wages, it's awfully hard to pull them back unless a recession hits, and then workers are happy to have a job. But remember, too, the Fed has a dual mandate, price stability and a full unemployment.
Quincy, for those of us in the market, stuck there, now seeing the losses, what is it? Sit and wait it out, 1 year, 3 year, 5 years, don't sell into this market?
I mean, unless you have to raise cash, unless you get a call this afternoon and, it's a margin call, you'll be forced to sell. If you don't have to sell, it usually helps to wait it out. And the reason for that is if the Fed breaks something, that's what we call it, break something, they're prepared to change course. Even if nothing breaks and the economy really slows and we don't get a soft landing, pretty soon the Fed will start lowering interest rates. That's the pattern. And then the market knows that before anybody else. The market gets the news first. So today, the market is sending the signal. It got the news yesterday from the Fed, and today it's saying, maybe, just maybe, we don't agree with you.